Hey everyone, and welcome. Look, today we're not just going to stare at some charts, we're going to tear them apart. Think of this as a hands-on workshop where we're going to dismantle all those common trading myths and completely rebuild your strategy from the ground up, using the exact same playbook the pros use to see the market.
So let me kick things off with a question that I'm willing to bet is, well, painfully familiar. You've done the work, you've found a great setup, you get into the trade feeling pretty good about it. You set your stop loss exactly where the book tells you to, and then what happens? The price moves against you, taps your stop loss like to the penny, and then immediately takes off in the direction you predicted all along. It's maddening, right? But what if I told you that's not an accident? What if it's all part of the plan?
You see, it's not bad luck, and it's not that your analysis was wrong. It's that those very chart patterns you were taught to trust, the double tops, the head and shoulders, all of it, they're actually the building blocks for market traps. They're put there to make you act predictably, so your stop loss becomes the fuel for the real move.
So here's our game plan for this explainer. First, we're going to expose the retail trader's track. Then, we'll learn how to follow the big money by understanding liquidity. After that, we'll build a simple three-step strategy around it. We'll talk about how to nail the perfect entry, we'll cover the discipline of patience, and we'll wrap it all up with a new daily checklist to make all of this second nature.
Okay, let's dive into Section 1, the retail trader's trap. Before we can build a strategy that works, we have to understand exactly why the old one was built to fail.
This slide says it all, really. It's two sides of the same coin. On the left, you've got the retail view. They see a break of structure, and the alarm bells go off. Okay, trend is up. I need to buy the next pullback. But the pro, they see the exact same thing and think, perfect, the buyers are jumping in. Now there's a nice big pool of stop losses sitting right below that last low, just waiting to be collected. It is a completely different world. And this quote from Marco Acetoni just hits the nail on the head. These patterns have to work, sometimes, right? If they failed 100% of the time, we'd all just stop using them. But by working just often enough, they create predictable behavior. They get thousands of traders to put their stops in the same obvious places. That isn't a market inefficiency, that is market engineering. Which brings us right to Section 2, and honestly, this is the heart of the entire strategy, liquidity. I want you to just, for a second, forget everything you know about indicators, trend lines, all of it. The real engine of the market, the fuel for every single major move, is liquidity. And that's what we need to train our eyes to see.
So what is this liquidity thing anyway? It sounds complicated, but it's actually super simple. It's just a bunch of orders sitting in the market waiting to be filled. And while that includes buy limits and sell limits, the most powerful, most targeted type of liquidity is that giant, shimmering pool of stop losses from all the other traders. That's the prize.
So let's just walk through how this is built, step by step. First, the market makes a clear high and then sells off, making it look like a strong resistance level. What does that do? It convinces sellers to jump in, thinking the price is going down. So, where do they put their stop losses? You guessed it, right above that strong high. And boom, just like that, a huge pool of buy orders, their stops, has just been created. That pool of money is now a magnet for price.
All right, so we've seen the trap and we've identified the fuel. Now for the fun part. How do we actually use this? In Section 3, we're building our strategy, and it's a simple but incredibly powerful three-step process for turning their trap into our setup.
This is it, the whole game plan in 3 simple actions. Number 1, you become a liquidity hunter. Your only job is to scan the chart and find where the market has tempted people in and, by extension, where their stop losses are clustered. Number 2, and this is the hardest part, you wait. You do nothing. You let the market make its move to go grab that liquidity. And finally, number 3, once the trap has been sprung, once the stops are hit, that's when you enter. You get in right as the real institutional move begins. Identify, wait, enter. That's it.
And this leads us to the golden rule of this whole thing, which is going to feel completely backward from everything you've probably ever learned. We train ourselves to buy below major lows, right after the sell stops have been wiped out. And we look to sell above major highs, right as all the breakout buyers are getting trapped. We are literally looking to enter at the point of maximum pain for everyone else.
Okay, on to Section 4, nailing the perfect entry. Now, the real magic of this whole concept is that it's fractal. That's just a fancy way of saying that the same games being played on the daily chart are happening on the 15-minute chart, and even all the way down to the 1-minute chart.
We're going to use this to stack the odds in our favor and find really precise entries.
See, pros don't just take a signal on one chart. They build a case. They start high, maybe on a 4-hour chart, to figure out the main target, that big, obvious pool of liquidity we call external liquidity. Then they'll zoom in, maybe to a 15-minute, to watch the trap actually get built as price moves closer. And finally, once that trap is sprung, they drop all the way down to a 1-minute chart to find that perfect low-risk entry signal. It's a top-down approach every time.
Let's make this really simple. Think of external liquidity as your destination. It's that major high or low on the big chart that you think the market is ultimately heading towards. Internal liquidity, on the other hand, is your entry ticket. It's the smaller, more recent pool of stops that gets taken out right before the big move begins. So the whole trade model is this. Wait for internal liquidity to get swept, then enter and aim for external.
Okay, now we need to talk about what is, without a doubt, the most important part of this whole thing, the patience payoff. Look, knowing what the setup looks like is easy. The real skill, the thing that separates the pros from everyone else, is having the discipline to just wait for it.
I love this quote. You have to sit on your hands. With this strategy, waiting isn't passive, it's an active strategic decision. You are actively letting the market build the trap for somebody else. If you pull up a chart and you can't immediately see the obvious pool of liquidity, then there's nothing to do. It's that simple. No setup, no trade.
But right here, this is where that little voice in your head starts screaming. It's FOMO, the fear of missing out. You know, what if you wait for that sweep below the low, but the price never quite gets there? It just turns and goes without you. That feeling, that urge to just throw your plan out the window and chase it, it can be overwhelming.
Here is the rule, the one simple, powerful idea that will save you from that feeling. You define your level beforehand. You know the exact high or low that has to be taken for your setup to even exist. And if the market doesn't hit that spot, it wasn't your trade. You close the chart and you walk away. That single rule will protect you from so many bad impulsive trades.
All right, let's bring it all home. In our final section, we're going to combine everything we've talked about into a simple daily battle plan. This is the checklist that's going to guide you step by step to find and execute these trades every single day.
Here we go. Every morning, this is your new routine. Step 1, go to your 4-hour chart and get your bias. Where's the big picture external liquidity? Step 2, zoom in and map out the immediate trap. What's the closest internal high or low that needs to get run? Step 3, set an alert at that level and go do something else. Step 4, when your alert goes off, then you go to work. Drop to a low time frame, look for your entry signal, and execute. And Step 5, manage the trade with your eyes on the prize, that opposing external liquidity you found back in Step 1.
You see, this all comes down to one massive shift in your thinking. Your job is not to predict the future. It's not to be a fortune teller. Your job is to be a detective who simply reacts to what the market has just done. When you see liquidity get taken, the big players are showing you their hand. That's your clue. That's your time to act.
And that's a wrap on our workshop. Seriously, the next time you open up your charts, you're going to have a choice. Are you going to see the old patterns that are designed to trick you, or are you going to see the pools of liquidity that show you what's really going on? I think you know the answer.